Okay, I think we will get started. So good morning, everybody. Welcome to another in our series of enterprise webinars. My name is Estacada and I'm very pleased to be hosting you this morning. And today we are talking about electric car salary sacrifice. So if you're expecting to hear about anything else, then you're in the wrong webinar. And there'll be lots of other topics that we're covering throughout the year, details of which will be available on our website, and obviously invites will be sent out in due course. I think most of you, or many of you certainly probably do know who we are. There are lots of familiar names on the delegate list, but for those of you who are less familiar, Moore Smith is a top 15 audit, tax and advisory firm. We work with lots of businesses right across all the different commercial sectors, as well as not-for-profit businesses and private clients. We're also part of More Global, which is an international network with presence in over 100 countries. So today we're talking about electric car salary sacrifice. Now this is, salary sacrifice in general is a very well established tax efficient way of providing your employees with benefits. The demand for green credentials, of course, is on the up, and generally speaking, the popularity of electric vehicles is increasing. So obtaining an electric vehicle via this method isn't just really good for your ESG credits, but it's also a really tax efficient way that you can deliver considerable savings at no cost to the business. And it also helps to attract and retain employees, which I'm sure most of you will agree is really important at this time when the job market is actually pretty challenging. So I'm delighted to be joined this morning by Tim Stavold, who is Head of Tax at Moore Smith, John Williams, who is an Employment Tax Director at Moore Smith, Amy Cretton, an HR Director at Moore Smith, and last but not least, Rob Wentworth-James, who is a Corporate Sales Director at Fleet Alliance. So just a little bit about Fleet Alliance then. They are the chosen partner of Lloyds to manage their salary sacrifice schemes for schemes of less than 1,000 employees, and have been doing that on their behalf for 20 years. Rob has been director of a major accounts division for 8 years and presents to major clients of the bank, and he's been involved in leasing and fleet management and salary sacrifice for some 30 years. So if there isn't anything that he doesn't know, that will be a surprise, a guru. A little bit of housekeeping before we start. Please do ask questions. Not just at the end, but as we go through, as they're relevant, and I will try to sort of weave them in. I'm going to do a bit of light sharing, so I'll try and weave those questions in. But please do make sure you ask those questions in the Q&A function, not the chat function. It's much easier to keep track of them in the Q&A. We are recording this session, so we will be sending round a recording to everybody who's joined us today. So please do share that with your colleagues and anyone else who would have liked to have joined us or who might be interested. And at the end, we will be circulating a feedback form. Please do fill it in. It's really short, it's really quick, but it's really useful to us in helping shape future webinars in terms of content and timing, etc., etc. So let's kick off then. So I think everybody who's about to speak, Tim, John and Amy, maybe take your mute buttons off. Don't make the mistake I made earlier. So we will kick off with you three. So I think the first one really is for you, Tim, in terms of broadly speaking, what are the tax implications for a company that wants to provide an electric car to their employees?
Okay, so here we're talking about a company providing the car. So this is a company acquiring the car either outright or under lease. The tax system is pretty generous in this regard. So if a company's buying the car outright, well, that's a less common approach these days, but if it's buying it outright, there's 100% tax deduction for the cost of the car. So if you spend £50,000 on an electric car, you can deduct £50,000 from your profits. The sting in the tail there is if the car's sold in the future for anything more than zero, there's going to be a clawback. So you buy a car for £50,000, you sell it for 30,000 years to come later, and there'll be an add back to your profits of the 30,000 you've received. So you only get tax relief for the 20. But the upfront tax relief is pretty good. It's a nice tax deduction to have when you've got profits to offset it against. More common we see these days actually is leasing though. So with if a company is taking a lease for an electric car, the lease rental is fully tax deductible, lease provided the car's got less than 50 grams of CO2 emissions per kilometre. So we're talking, a fully electric car is going to meet that threshold. Cars above that threshold, the lease deduction is restricted to only deduct 85% of the lease. So we've got a win there. We can deduct the full lease rental. We can recover 50% of the VAT on the lease rental as well. So unusual to recover VAT on cars, but on lease rental cars, you can recover some of the VAT. So that's all good news. The bad news, although it's very small bad news, is there's a little bit of national insurance payable, Class 1A national insurance at the new rate of 15.05% on the benefit provided to the employee, which we'll come on to in a moment.
And what about the tax implications for the employees and maybe family members as well, perhaps?
Yeah, so for the employees, not for a long time in my script of talking to clients, I'd always say, look, company cars are nuts. You know, the government have done a great job of making company cars very unattractive by taxing them into almost non-existence. That has completely changed with electric cars. So amongst our client base, very few had large company car fleets. With electric cars, that's completely pivoted the regime we live in. So the company car charge is based on the list price of the car. If you're in a petrol guzzling or diesel guzzling Mercedes or some big gas guzzler, it's up to 37% of the list price. But for electric cars, the percentage that derives the benefit in kind is only 2% at the moment, and it's fixed at 2% until 2024-25. Now, from that point onwards, it may go up due to the popularity of this scheme, but it's going to go up to 3 or 4% at the top end, I would have thought. So 2% benefit in kind. What that means is if the list price of the car is, say, £50,000, we're talking 2% of that is the benefit in kind, so £1,000, and that's the sum which is going to suffer tax. So for a 40% taxpayer, the benefit of £1,000 is going to cost them £400 a year in tax. Normally, we recommend that's put through the payroll, so you payroll the benefits, so we don't have to muck about with P11Ds. So the employee spreading a £400 tax liability over the year is barely going to feel it. You mentioned family members. This same arrangement can be dealt with for spouses, for children, for parents, or even spouses of children, where the employer could agree with the employee that as part of the remuneration package, they would provide a car to family members too. And the benefit in kind works in exactly the same way. There's no limitation on the number of cars that can be provided. So a very, very tax efficient scheme for employers and employees.
Presumably that benefit in kind for family members is still on the employee rather than directly on the family.
Yeah, so if the employee's marginal rate of tax is, say, 40%, then they would pay 40% on the benefit. But frankly, you have to drive a pretty fabulous car for 2% to add up to any sort of material benefit.
Yeah, absolutely. And I mean, maybe sort of coming across to you, John, and perhaps bringing in you, Amy. How does the salary sacrifice scheme work, and does this have implications also for the employee's contract?
Yeah, thanks, Esther. So, okay, in terms of how it works, the employer acquires a vehicle, and as Tim mentioned, typically that's under a lease arrangement with a third party like Fleet Alliance, and then the employee will in turn agree to give up, so sacrifice an amount of salary equivalent to that lease cost. So therefore, we're offsetting that cost that you as employer has actually incurred. And this needs to be a contractual arrangement between the employee and employer. So the employer then is able to provide the employee with this electric car, which they can use for personal or business use. Now, because the salary is given up before tax and national insurance contributions, this generates a large saving for both the employee and employer. And again, as Tim had mentioned, there is, of course, a benefit in kind tax charge for the fact you are, as an employer, providing an employee with a company car, but it's very low, 2%. And again, as Tim said, that's fixed until 2025. So I think it's probably best I show this by way of an example. We get into the detail, and I will attempt to share my screen now. And if someone on the panel could confirm that they can actually see it. Okay, that's great. So we've got an example here. We've got employee earns £65,000 per year, so they're a higher rate taxpayer. They've agreed or selected to be provided with a Volkswagen ID3, which is your typical family mid-size electric car, and I understand it's pretty much one of the most popular ones on order at the moment. The lease cost of that is £566 per month, and they're going to opt for a lease term of having the car for 3 years, and they're going to incur around 10,000 miles per annum. The significance of the mileage and the term of the lease is only it only impacts the lease cost. It doesn't impact the tax position. And then we've got the list price of the car, which is just over 32,000, and that's important for working out the benefit in kind charge. So if we can move to the next slide, which is a table, I can work you through line by line how this works. So right at the top, we got the monthly lease cost there, which initially the employer is having to enter in to pay that amount to the lease provider. So £566. As Tim mentioned, there is that VAT recovery. So 50% of that VAT can be recovered. Then the employee is giving up that amount of salary of £566. So they're paid £566 gross less. So effectively passing that back to the company. So at this point, the company is actually neutral on costs. And then returning to the employee, they're going to be saving income tax and employee NIC because they're no longer taxed on that £566 of salary. So we've got £226 saving of income tax per month. We've got £18 of employee NIC per month. And also looking over to the right here, we've got an employer secondary NIC saving of £85 per month of what would otherwise have had to have been paid on that £566 of salary. And if you're an apprenticeship levy paying employer, then there's a further or very small saving of just over £2 per month. Now, we've got this benefit in kind tax charge that we keep mentioning. It's very low. It's worked out at 2% times that list price of just over £30,000 times their marginal rate of tax, which in this case was 40%. So it's actually only £21 per month an employee would have to pay there in terms of a benefit in kind charge. And the employer class 1A NIC, which is incurred on this benefit, is only £8.10 per month. And that's a cost for the employer. So we get to the bottom of this table and you can see the true cost for the employee of having access and use of this car is actually only £342 per month. So effectively discounted by the tax and NIC saving mentioned above. And the employer is up. They're actually up. They're saving £127 per month compared with if they just paid them that full salary, including the £566. And I've included here a table which really illustrates the cost saving. We said before, we got the £342 per month cost for the employee under this arrangement. Now you compare that with the employee going out to lease this cost personally, so under a personal contract hire, they would have to pay the full £566 out of their net pay. So there's a saving of over £220 per month under this salary sacrifice arrangement. And over the term of the lease of 36 months, it's over £8,000 saving of motoring costs, which is significant. And looking to the employer side of things, I've mentioned in that previous table, £127 per month saving if an employee opts for this electric car instead of having that £566 of salary. And over a lease term, that's over £4,500 of savings. So again, there's material saving for the employer. And this can be tweaked so that those employer savings could actually be passed on to the employee. Don't have to do that, but you could do that, and that would reduce the cost of the employee having this car even further. So there's a few permutations that can be played with there and tailored. But what I'd also mentioned was that there is a need to have some form of contractual terms in place for this to be effective. And I'm actually looking to you, Amy, because this is your area. And what's your experience of dealing with the contractual amendment side of this to make sure that it is effective?
Yeah, it will be a contractual change, and I think employees need to be aware of that before they enter into it, because it has other implications as well. So it will change how you calculate the day rate. So for things like sick leave or holiday or even notice periods and things like that, all of that will be calculated at the new rate of pay, because it's a contractual term now, as opposed to the original base salary, which they would have been on. So it does have other implications as well. So it's just important to make sure that employees are aware of that before they enter into this agreement.
I'm just going to deviate a little from some of the planned questions. We've got quite a lot of Q&A coming from the audience. So one of the questions is, and I'm not sure actually, this possibly might be one for you, Rob, who would be responsible for insuring and maintaining the car if you're leasing it?
Thanks, Esther. Fundamentally, this is a business car, so as a result, fleet insurance as opposed to personal insurance would need to be included within the quotation. Within the setup that Fleet Alliance has created, we work with a company called Lloyd Latchford, and they include the fleet insurance as part of that salary sacrifice rental. The real advantage of that is because it's included within the rental, it's actually become far more tax efficient because it's then folded into the cost. The other great advantage is that it's fixed for the entire period of the lease, which, dare I say, in this environment, it's very rare that insurance doesn't jump, regardless of whether you make a claim or otherwise. So in that regard, it's very efficient.
So there aren't any hidden costs then. So that sort of spreadsheet that jump out, that example, that really does capture everything. And actually, on a related point, you said that, you know, about this being fixed for the term of the lease. Another question actually was, is the lease amount a fixed amount each month, or does that tend to be more at the beginning of the lease?
No, the lease payment is fixed for the entire period of the lease, or the rental payment is fixed for the entire period of the lease. The other great advantage of this facility, as compared with something like personal leasing, is it doesn't invoke a very large deposit. So it's a standard one in advance, followed by 47 or followed by 35, depending on the period of the lease. So in that regard, it's very accessible.
And what happens if the employee leaves the company sort of partway through the lease agreement?
Right. Okay. I have got a slide on that.
I think watch this space, because I think that's where a lot of the debate is, and we'll come back to that.
We'll come back to that later then. So Amy, I think we were sort of also thinking about what sort of people, you know, you might offer this scheme to. Is this a scheme you'd offer to everybody, or just sort of a smaller pot of people?
So you can decide as a company how you want this policy to work. So you can put certain eligibility criteria in, whether that's length of service or seniority. You can restrict how much of a salary can be sacrificed. So obviously there's the usual, you can't salary sacrifice enough that it would take you below minimum wage, but the company can reduce that even further as well. So they might say you can only salary sacrifice 20% of your salary, for example, to help that kind of situation if someone was to leave during the lease agreement, to protect yourself. There are some things to consider, so you don't have to offer it to everyone, but just be careful of discrimination. So if someone is reaching a certain age and you don't want to offer it to them because they're reaching state pension age, for example, obviously retirement doesn't exist anymore as a standard, so that could potentially be discriminatory. Obviously don't offer it to all the women or all the men, that kind of thing, but I'm sure no one would do that anyway. But yeah, so there's just some things to consider to make sure that you're not doing anything that could be deemed discriminatory, but you can reduce the pool of people that you want to offer it to, as long as there's an objective reason.
Brilliant, thank you, Amy. And then maybe some small sort of specific points, Tim, and I'm going to bring some of the audience questions in here as well. What about the tax treatment of employer provided charging points? That's the obvious time to charge your vehicle, isn't it, while you're at work?
Yeah, so the charging, and there's lots of debate at the moment about the cost of electricity, but employer provided charging, if you can actually go drive to work and plug it in when you get there or near the office, and there's pages of revenue guidance about what near the office actually means, but if it's employer provided charging, that's a completely tax exempt benefit as well. If the employee charges their car at home and then only uses their car to drive to Tesco's and back, so it's all private mileage, if the employer reimburses that, of course, that's going to be taxable. If the employee charges their car at home and then charges the business for their business mileage, they either can have the sort of 5p per mile, no questions asked. All you need to do is prove the mileage that you've done. You don't need to prove the cost of your electricity, and the general feeling is that 5p per mile is a bit low at the moment. Or you can actually calculate the actual cost of electricity, and there's lots of sort of technology solutions to try and work out the cost of your electricity and the miles driven. So there's all sorts of apps and things that can help you do that. The final thing on charging, if an employer pays to actually have a charging point installed in your home, rather than running an extension socket from the living room out to the driveway, you can actually have a fast charge point put at home, and the employer can pay for that. The employer paying for that to be installed at home is also a tax exempt benefit. And I think, Rob, that can be rolled into the lease cost as well. So if it's £900 to have a charging point installed at home, you can amortize that over the cost of the lease, I think, Rob, from an earlier chat we had.
You can indeed, and also that then can be salary sacrificed as well, Tim. So it becomes even more efficient, and therefore means it's only about £400-500.
Yeah, I mean, we've even on the actual charging the vehicles looked at employers lending their employees the money to actually put solar panels on the roof and have a Zappi charger connected to those too, and a home battery. I mean, you can go completely mad on the ESG stuff. An employer provided loans of up to £10,000 have no tax consequences either for the employee. So that's about the cost of a solar installation. So if you really want to actually embrace this fully, it's more than just sticking a car on the driveway.
Yeah, no, absolutely. And what about, and again, we've had a couple of questions come in, what about the implications for partners of partnership or self-employed?
Well, I mean, I want maybe some of the partners from this partnership on the call, and it was a sort of real crestfallen call where they'd all decided to implement this for the partners in the partnership. And my first question was, well, how many business miles do you drive? Because, the real tax advantage here is for employees around the benefit in kind. If you're a partner in a partnership or you're self-employed, you're back to looking at the business use and the private use. So if you've got a lease cost of £1,000 a month, but you only drive 10% of the time for business miles, the tax deduction is only going to be for 10% of the lease cost. The other 90% is a non-business expense. So, given most of our professional firms clients are London and Southeast based, those London-based ones, the professional firms drive very little mileage. So for the self-employed and for partners in a partnership, this isn't as tax efficient unless a lot of business miles are driven. For employees, it doesn't matter whether it's one business mile or none. If it's fully private use, this all still works, which is a big diversion between the employed and the self-employed.
Yeah. And presumably this scheme would apply as much to second-hand electric cars as well as brand new.
Well, the cars need to be new or new other than driven as a demonstration car. Or if you're claiming the capital allowance, if the company's buying the car outright and wants the 100% capital allowance to deduct the full cost against its profits, they need to be new cars, and that's a problem because second-hand cars are sometimes easier to get your hands on more quickly. For the leasing side, I can't think, Rob, any reason why the car would need to be new, although I guess for leasing, the cars are nearly always new anyway.
Yeah, in principle, Tim, I think the problem is that EVs are still relatively in their infancy. So as a result, there isn't a great deal of product coming back into the market. However, our plan is eventually to be launching a second-hand salary sacrifice scheme. And that's obviously going to be very effective, cost effective, as and when it comes in for salary sacrifice.
Yeah, so for the lease cars don't need to be new, but you'll struggle to find second-hand ones right now. But for the capital allowance, they definitely need to be new, and that's a bit of a bear trap. If in the dealership you think you're getting a better deal, but you're going to miss out on the capital allowance if you're buying it outright.
And what about, somebody's asked, is there still any benefit of doing salary sacrifice for a non-electric car? Now I know there's a whole raft of detailed calculations that need to be done.
You can. I mean, the low benefit in kind rates, apply to those cars with zero emissions. If you're driving something with low emissions, say 50 grams per kilometre, where I think the benefit in kind rates start to tick up, you're looking at the 3, 4, 5% benefit in kind rate rather than the 2% rate. So it's still worthwhile. I always say to clients, look, the electric car salary sacrifice, if you can get your head around the detail, is a no-brainer. Everything else you need to crunch the numbers and just make sure it works for you. So if you're thinking about putting a Porsche 911 through a salary sacrifice scheme, probably not, because you'll be taxed on 37% of the list price every year.
And what about, you talked about the 50% VAT reclaim, what about the sort of businesses such as schools, for example, that are exempt?
Yeah, I mean, the VAT rate is reclaim is only for VAT reclaiming businesses. So if you're VAT registered, yes, you can reclaim the VAT. If you're not in the position that you can recover VAT on your expenses more generally, there's no special regime here where you'll get it back. So yeah, I should have said that in the presentation. If you don't recover VAT, you still won't get any back on this element.
Yeah, sure. Okay, brilliant. All right, well, I think there's still lots of questions there. Maybe some of the panelists could pick up some of those questions whilst we move over to Rob, and any that are left we can answer afterwards, or we'll try and weave them in. So Rob, I mean, maybe just give us a little bit more of an introduction. Obviously I talked about it very briefly, but maybe a little bit more of an introduction about you know, who Fleet Alliance are and how you work.
Wonderful. Good. Okay. In essence, Fleet Alliance is a partner of Lloyd's, and the reason why we're able to offer this salary sacrifice scheme is because the majority of the market for salary sacrifice is dedicated towards very large volumes of employees, whereas our scheme can be rolled out for employee sizes of any kind. I think we're a trusted supplier of the bank, primarily because we look after their clients in the same direction as they would, and also because we're independent. Our advice is seen very much as being in the client best interest as opposed to any partisan interest. We've been in existence for 20 odd years. I've been with the business for 8 years. I look after, as Esther said earlier, the management of the major accounts division. And obviously the Lloyd's account is a very significant one for us. In terms of the reason why our scheme is ahead of the market, then, sorry, I'm just having a bit of a technology issue. Right. The difference between our solution and that you would normally find in the market is, one, we don't just take the lease rentals from one single supplier, we multi-supply, we competitively tender this. And that has been capable of saving our clients between about 7 and 15%. As I'm sure we're all aware, no one leasing company has the monopoly on the cheapest rental all of the time, particularly across what is a relatively new environment of EVs. And as a result of that, we think that just by sticking with one supplier, then you can actually put yourself in a position where you're losing out in terms of cost savings. One of the other key advantages is, and I think this is an important thing, particularly to do with what Tim mentioned earlier, in that the employer can fold in the savings, the employer NI savings, into the employee lease rental. We would suggest primarily, the reason why that's done is obviously to lower the rental, but what it can do is, if you don't fold that in, you can actually use it for a contingency fund to protect you against early terminations, and I'll cover more of that in a little while. Much of the market has, dare I say, over the last 15, 20 years, been extraordinarily profitable on the back of these lifestyle insurances for maternity, resignation, redundancy, adoption leave, etc. And that has probably made the scheme quite unattractive, which is why the larger companies operate only with employee sizes of over 1,000. So we think that provides a significant differential between ourselves and the competition. The scheme, as far as we're concerned, is very much light touch. We provide all of the paperwork to get the scheme up and running. We're also responsible for all of the marketing and special offers and the likes. I'm sure everybody is aware there is a problem with delivery of new vehicles at the moment because of semiconductors. And as a result of that, what we do is we make sure that we're pulling in vehicles that are very popular, both across our contract hire fleet as well as the salary sacrifice fleet. And that, we believe, gives employees an advantage of accelerating their orders through the system. The other thing is, in order to make the life of your employees much easier, we provide you with some very good technology, which allows the employees to access all of their in-life services, as well as a number of helpful how-to guides, particularly with regard to one of the issues of what happens if I early terminate. a vehicle, what happens in terms of excess mileage, what happens in terms of any damage, because those will be down to the employee and those can be written into the policy and will help you structure a policy that fully protects you.
Brilliant. So I think, one of the questions is in terms of, what's the minimum number of cars that can be included? But I think from what we're saying, the minimum is one, really.
Yeah, it is indeed. And as you can see from this particular slide, there's no particular concentration on any manufacturers. You can open the scheme up to be as wide as you actually like. The only thing with our scheme is that it has to be pure EV. And part of that is actually down to the fact that the OPRA, the regulations related to cash allowances, we believe in the future the government will probably rule against hybrids in this regard. And what that will do then is that will remove that entirely from the scheme. But effectively, because EVs throw zero emissions out the tailpipe, then we believe that's going to be far more certain for the future in terms of.
So you're saying that hybrids aren't included at the moment, and you don't think they will be?
No, we don't think so. Primarily in 2035, it's only going to be EV. 2030, hybrids have got a short stay of execution. But effectively, if you were to look at the 600-700 models that are actually on the market at the moment, probably 80% of those are already pure EV. I do recognise that for a lot of companies or individuals, this issue to do with range anxiety does become an issue, but infrastructure is increasing massively. And also fairly recently, Mercedes, by way of example, ran a concept car from the bottom of the UK up to Glasgow, so a journey of over 600 miles. So the longer distance in terms of battery technology is definitely coming.
There's lots of different models on there, obviously, each with different sort of types within that. What tends to be the most popular for the leasing schemes, if you're allowed to say?
Well, the interesting thing is, of course, and it was mentioned earlier, everybody wants a Porsche Taycan. But dare I say, if you're looking at when can I actually get my hands on one of those, then you're looking Q1, Q2 of next year. But I would suggest probably the most popular, certainly VW, although they are experiencing issues to do with supply at the moment on ID3 and ID4. Tesla, hugely popular, and I have to stick my hand up as being one of the individuals that run a car like that. Picked it up in 2019, 0% benefit in kind, 1% last year, 2% this year. It's from an employee perspective, is genuinely a no-brainer. Some of the other manufacturers, Hyundai and Kia, are producing some very dynamic vehicles. For example, by way of example, my wife runs a RAV4 at the moment. It cost me £300. I have to put insurance on top of it. I could end up with either a Peugeot 2008 or a Kia EV for pretty much the same amount of money once you salary sacrifice it. Again, from the point of view of tax efficiency, it genuinely is a no-brainer.
And what is the most typical length of a lease, and what does happen when it ends? Because we've had quite a lot of questions coming around. What happens if an employee leaves? What happens if they go on maternity leave, etc., etc.?
Well, nice segue there, Esther. Typical leasing period can be anything between 2 and 4 years. Coming back to that issue of what happens when people leave, on the assumption that you're going to be offering in terms of eligibility to those employees that you're fairly certain going to be around for at least 2 years or 3 years. 3 years is probably the most common period. 4 years probably works for senior management, people who have got a real investment within the business, that you're certainly going to be sticking around, because again, that will reduce the implicit
or Rob, just cutting across, or owner managers. So a lot of our clients and people on this this webinar will be people who own their own companies, and they've probably got a bit less concern that they're going to resign from their own company. So they will just structure a lease that's as cost efficient as possible. But for your employees, where the attrition may come in, a lease of 2 or 3 years with this national insurance saving building up the war chest to dealing with the cost of them leaving early, which I'll let Rob pick back up.
Yeah, indeed, Tim. And your point earlier was extremely applicable here, and that is that if it's an owner business, then you can automatically fold the employer NI savings into the lease cost to further reduce the rental. So we've already, I think, just covered it within our scheme. Up to 2 additional family members can be included. Our logic, or the logic for that, is we assume that for most businesses, once you've taken in 3 cars, then you could be threatening national minimum wage, but obviously it's all down to income level. So hopefully that explains that. I am on the next slide just going to cover off where the scheme protects you against bad leavers, and part of that is down to what Amy said earlier, which is about the eligibility file, who you actually choose to have on the scheme, obviously making sure that you don't discriminate. So if I just cover on that particular point, early termination, effectively salary sacrifice is business contract hire by any other name. It's just delivered through a different tax delivery mechanism. So right at the outset, you've got to clearly define who the employees are on the scheme. So you wouldn't offer this to anybody who was in probation at this point, or anybody who's under threat of restructure within the business. You wouldn't, as a general rule, offer it to anybody unless their salary was about 20% above national minimum wage, again, to give them some clear headroom. So the options that exist for you are, you can either reallocate the vehicle and put it in as a business car, and as a result, we would strip out the insurance within that, and then that vehicle would then go under your standard fleet insurance. You can actually reallocate it as a second user salary sacrifice scheme. So as a result, that almost ties in with this kind of used vehicle on salary sacrifice. Now, the advantage of that is that because you know that if you had to early terminate, there would be a penalty coming towards the business, you could use that to further subsidize the second user on salary sacrifice. So if the salary sacrifice rental was £600, you could say to the individual, look, I know it's not a brand new vehicle, but you can have it for 450, and you would still be saving something, and the employee would be saving as well. The other thing is, in terms of the structuring of the policy, so this is the policy between you and the employee. There are a number of ways you can protect yourself. One, we suggest a small penalty. Ultimately, this is a very highly valued HR benefit, and as a result, we don't believe that your employees should just take it up and then vanish. So we expect there to be a level of jeopardy, and our normal recommendation is that in year 1 they pay 3 rentals, year 2 they pay 2 rentals, year 3 they pay 1. Added to that, you can also build in what we would call a policy accrual. So if the salary sacrifice rental was £600, you might build up an accrual of £20, £25, and put that again with the national insurance savings, the employer national insurance savings, which again builds up a very healthy pot. Even just on the NI savings, we believe that if 10 people were to take up the vehicle or take up the scheme, you'd have to have at least 3 early terminations before the scheme didn't pay for itself. Once you build in the policy accrual and also the employee early termination penalty, we suggest that attrition rate goes up over 50%. So again, our scheme is a lot more proactive than that exists in the market. As a result, it gets far bigger take up because it's far more attractive, but you're still protected fully.
So, I mean, a lot of the questions, Rob, have come in as what happens if my employee leaves early, and we knew in preparing for this session that would be the main question, because what we'd hoped was the employee can just throw the keys back at you, and that's the end of the day you pick up the car, and it's the end of the story. That is a dream world, I'm afraid. Attendees, there is no lease provider out there that will just let you throw the keys back at them. So we're looking at other alternatives. I must say, although it's taken me a little while to get my head around it, the savings for the employer, the reason when John put his numbers up, we actually had a saving for the employer. I think on the monthly saving was £140, something like that. that's not necessarily for the employer to enrich themselves with and add to their bottom line. That's to put in a war chest to deal with the cost of early terminations. And Rob's got some wonderful calculations and tools which actually you can model your employee base, stick in an attrition rate, and start to work out what you need to set aside for the early terminations. And there are lots of ways of skinning the proverbial cat. There are other solutions out there. I think Rob mentioned them briefly, of insurance-based solutions, but we actually think looking at the national insurance saving, almost self-insuring, is a more cost-effective thing to do rather than enriching an insurance company where a lot of the benefits are being lost to another party.
Definitely, and in our opinion, you've never met a poor insurer, and the fact is, for us, it's about risk management. It's not about risk avoidance.
Yeah.
Given the lead time on getting new vehicles, the reallocating the vehicles within the employee population must be popular, I guess. Rob, that must happen a lot.
It is. Obviously, it's a far more popular option if you're already running a company car fleet, as well as a salary sacrifice scheme for your cash for car and also your non-car eligible employees. But yes, to reallocate it and to subsidise it as a second user salary sacrifice is going to be very popular, we would suggest.
A couple of questions coming around. What happens to the car at the end of the lease? Do you just give it back, or can you keep it? And can you buy it outright when you come to the end of the lease?
Yes, the employee can, but the employer can't, as would be the case for standard business contract hire. There are two important things to recognise at the end of the lease. One, and some of your employees might be quite cute on this, is they say, well, I'll put the contract at 5,000 miles, and then I know that I'm going to do 10 or 20,000 miles. The policy will actually capture that for you, and all excess mileage is actually down to the employee. The clever bit about the technology that we provide is because we're sucking in mileage either through the app, and we will send out a reminder to your drivers to update their mileage. We can then look at either rescheduling the contract if their mileage is out of kilter with projected, and that protects you. Also, the policy document will say that any excess mileage is down to you. The same thing also applies to damage. Under business contract hire, that normally goes back to the employer, and then the employer should have something in their policy to say, we will charge you if you've been keeping goats in our car. The same thing entirely applies to salary sacrifice, that the damage is down to them. However, we're very proactive in this regard as well. Several weeks before the vehicle is due for return, because obviously we ideally want them to take out another lease, we'll send a notification out to your employees to say, have you got your second key? Have you had your vehicle fully serviced? Have you got your locking wheel nuts on? Oh, by the way, if your vehicle does look as if it's in a state where it's likely to get pinged by the contract hire company, let us know, and we can perhaps arrange a smart repair to be done. And as a result, that mitigates many of those costs. But again, those two costs are down to the employee.
Thank you, Rob. I'm conscious that we have billed this to 10:45 and we are nearly there. There are a few questions left. We will get the panelists to individually answer those, but I'm going to finish with one last question for you, Rob, which was actually asked quite near the beginning, which is that one of the benefits of electric cars has been, of course, the cost of charging is materially less than the cost of fuel, but given the spike in utility costs, do you expect this differential to remain significant? What's your crystal ball, Rob?
I think, well, from a personal perspective, and it was more by luck than great design, but I'm on a fixed tariff, which sadly ends at the end of August. So I'm still getting my fuel at 13 pence a kilowatt hour. The fact is, it's going to go up. I think with more inspired ways of tracking actual mileage, then you don't have to pay the AFR rate. But I think, as with all of these things, Esther, it's about, firstly, I suppose, cutting down on unnecessary journeys, but it's also about making sure that you go and negotiate the right tariff. Fundamentally, I wish I did have a crystal ball, as I'd be on an island, not a very worthy seminar by MKS.
Indeed, indeed. Well, thank you so much to all of our panelists for a very insightful webinar. There's lots of detail there, so if anyone wants any sort of detailed follow-up chats, please do get in contact with Tim or John or Amy, or if you want to speak to Rob, then obviously we can facilitate that as well. But thank you to all of our delegates for joining us today. Like I say, it was a pretty popular subject, and I think will become increasingly popular over the next few years. So thank you very much. Remember, we are circulating recordings. Please do fill in the feedback form. That's really, really useful to us. And hopefully we will see you all on our next webinar, which is on the 26th of May. And that is on the economy with the lovely Greg Purden, who some of you may have already heard from at a more unusual lunchtime slot. But invites will be sent out in due course for that. So hope to see many of you there. Thank you very much and enjoy the rest of your day. Thank you.
Thanks, Paul.
Bye-bye.
Cheers. Bye.